Welcome, and thank you for joining me today for this deep dive into active investing. While many investors rely on defensive strategies for stability, Benjamin Graham, the father of value investing, also saw the potential in active investing for those who are willing to put in the work. In this video, we're going to cover what it means to be an active investor, the qualities you need to succeed, how to identify market inefficiencies, and how to approach active investing with discipline and strategic thinking. What is active investing? Active investing is the strategy where investors try to outperform the market by making well-timed, well-researched investments, rather than simply tracking market indices. This strategy relies on the idea that markets are not perfectly efficient at all times, meaning there are opportunities to exploit if you can identify them. While Benjamin Graham is famous for his defensive investing principles, he also recognized that active investors can capitalize on market inefficiencies, especially when they are well-informed and disciplined. Overview of the video structure. We will break down the key components of active investing, explore the importance of research and discipline, and walk through examples to show how to apply these principles effectively in today's markets. The foundation of active investing: understanding market inefficiencies. One of the core principles of active investing is identifying market inefficiencies, situations where stock prices do not reflect their true intrinsic value. This can happen for various reasons, such as investor emotions, lack of information, or short-term market focus. Explain the efficient market hypothesis. The EMH suggests that it is impossible to outperform the market because all information is already reflected in stock prices. But Graham believed that there were inefficiencies in the market that active investors could exploit. Examples of inefficiencies: for example, companies may be undervalued because they're out of favor with investors or experiencing short-term issues. An active investor who does their homework can capitalize on these opportunities. The active investor mindset. Active investors need to be engaged and informed. It's not enough to follow the market trends or pick stocks based on short-term movements. You must do the research to identify undervalued assets and understand the company's true value. An active investor is disciplined and patient. Emotional investing, or making decisions based on market noise, will lead to poor outcomes. The key is to remain rational, even when the market is fluctuating. Discuss the importance of having a long-term perspective while being active in the market. Qualities of a successful active investor: informed and research-driven. To succeed, you must stay well-informed. This means doing your due diligence, studying financial statements, understanding a company's business model, evaluating its management team, and assessing industry conditions. Discipline. Active investing is not about making impulse decisions based on rumors or fear of missing out. It's about creating a strategy and sticking to it, even when others are panicking. Patience and risk management. Active investors must understand risk management. Not every trade will be successful, but if you can manage risk while seeking out inefficiencies, you can build wealth over time. Adaptability. The market is constantly changing, so an active investor must be willing to adapt to new information and adjust their strategy when necessary. Key principles of active investing: research and fundamental analysis. Active investors must be research-driven. This means digging into a company's fundamentals, its earnings, revenue, debt levels, and growth prospects. Deep dive into financial statements. Walk through the key components of income statements, balance sheets, and cash flow statements. How to analyze them to assess whether a stock is undervalued. Key metrics. Discuss key valuation metrics like PV ratio, PB ratio, return on equity ROE, and free cash flow, and how to use them for decision-making. Researching industry trends. It's also important to understand the industry in which the company operates. Is the industry growing? What are the market conditions? Is the company well positioned to take advantage of trends? Technical analysis for active investors. While Graham primarily focused on fundamental analysis, an active investor also needs to be proficient in technical analysis. Understanding charts, patterns, and price movements can provide valuable insights into when to enter or exit a position. Key concepts in technical analysis. Explain support and resistance levels, moving averages, and momentum indicators. Combining fundamental and technical analysis. Using both approaches allows active investors to make well-informed decisions. For example, a company might be fundamentally sound, but its stock may be overbought in the short term based on technical indicators. Building a diversified active portfolio. Even though active investing requires more attention and research, it's important to build a diversified portfolio to spread risk. While you're looking for opportunities, don't put all your money into one stock or sector. Discuss how to balance growth stocks, value stocks, and other asset classes within an active portfolio. Implementing active investing strategies. Active stock selection. Walk through how to select individual stocks using fundamental and technical analysis. Show how to assess a company's growth prospects, competitive advantage, and financial health. Provide real-world examples of stocks that were undervalued and how active investors spotted the opportunity before the market corrected the price. Discuss examples from Warren Buffett, Peter Lynch, and other successful active investors. Identifying market inefficiencies. Discuss real-world scenarios where the market misprices stocks. Sometimes the market underestimates a company because it's in a short-term slump or because investors are overly focused on headlines. Example of undervalued stocks during market downturns and how they were discovered by active investors. Walk through real-time example where a stock was mispriced and how an active investor would capitalize on it. Active trading versus long-term investing. Active trading. Some active investors engage in day trading or swing trading, looking to profit from short-term price movements. This requires a completely different strategy, focusing on timing and market trends. Long-term active investing. On the other hand, long-term active investors focus on holding stocks for a longer period, capitalizing on inefficiencies in the market and waiting for their true value to be realized. Discuss the difference in approach and mindset between the two strategies. Risk management and discipline. Risk management for active investors. Risk is inherent in active investing, but there are strategies to minimize it. Position sizing, stop-loss orders, and regular portfolio rebalancing are some ways to mitigate risks. Discuss how to manage risk based on a stock's volatility, your portfolio size, and your risk tolerance. Example: using a stop-loss to protect profits on an overvalued stock. The importance of discipline and patience. Active investors must have the discipline to stick to their plan, even when market conditions get tough. This means not jumping into the latest trend or making impulsive decisions based on market hype. Case studies of successful active investors. Share stories of investors who succeeded because of their discipline and long-term focus, even during periods of market volatility. Avoiding emotional investing. Emotions can be a major enemy for active investors. Fear of missing out, FOMO, panic selling, and greed can lead to poor decision-making. Staying calm, rational, and objective is crucial. Discuss how to develop the emotional resilience needed to stick with your investment strategy during market downturns. Case studies and real-world examples. Case Study 1. Warren Buffett's active investing approach. Walkthrough. Buffett's active investing style. How he uses his in-depth research to find companies with a wide moat and long-term growth prospects. Discuss his method of buying undervalued stocks with a strong management team and competitive advantages. Case Study 2. Peter Lynch's By Watching No approach. Explain how Peter Lynch capitalized on inefficiencies by investing in companies he understood, such as Fidelity Magellan Fund. Discuss his approach to finding companies with solid fundamentals but underappreciated by the market. Case Study 3. How active investors profited during the 2008 financial crisis. Discuss how some active investors used fundamental analysis to pick undervalued companies during the financial crisis. Provide examples of companies that rebounded strongly after being undervalued in the crisis. Conclusion and final thoughts. Active investing can be an effective strategy for those who are willing to put in the work. By focusing on research, market inefficiencies, and disciplined decision-making, you can outperform the market. Remember, active investing requires patience, discipline, and a deep understanding of market dynamics. The more informed you are, the better your chances of finding profitable opportunities, encouraging continued learning and engagement. Thank you for watching. I hope you are now better equipped to start actively investing with a disciplined and informed approach. If you enjoyed this content, make sure to like, comment, and subscribe for more detailed videos on investment strategies.